everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 109. This one is titled Delta and Strike Price Selection. We're going to be using a real-life example with Advanced Micro Devices, Inc., which trades on the NASDAQ exchange under the ticker symbol AMD. Over the years, I've been asked frequently, what delta should I use for my covered call writing trades? The assumption is that one specific delta will meet the needs of all investors at every point in time, and that's just simply not the case. So let's begin this podcast by describing what is a call delta. Now, there are actually three ways of defining delta. So let me give you those briefly, and then we'll move on with that real-life example. Now, delta is expressed in 0 to 1 for call options, or 0 to 100 for contracts. So a delta of 0.5 per share is the same as a delta of 50 per contract. Now, the three definitions are as follows. A very common one is it's the amount that an option value will change for every $1 change in the underlying security. So if an option premium is $2 and the delta is 50 or 0.5, and the stock moves up by $1, we would expect that premium to move up 50 cents from $2 to $2.50. Or if it went down $1, it would move down 50 cents from $2 to $1.50. So that's a very common definition, the amount that the option value will change for every $1 change in that underlying stock. Now, the definition that I like to focus on for this particular podcast, it's the probability of an option expiring in the money or with intrinsic value. So, for example, an in-the-money delta will be closer to 1. It'll be between 0.5 and 1, meaning that it'll have a greater probability of expiring in the money. That makes sense. That's its starting vantage point. Whereas a delta of a deep out-of-the-money call will have a delta closer to 0, and that means that there's much less probability of that option expiring with intrinsic value or in the money. Now, a third definition of delta, which is used by portfolio managers, institutional investors, is that delta is the equivalent number of shares. If you own a call option at a 50 delta, then you would own 50 shares of that stock. It would be the equivalent of owning 50 shares of that stock. Now, portfolio managers use this to frequently try to achieve a delta neutral portfolio, which minimizes overall market risk. So if you add up all of the positives and then all of the negatives relating to stocks and options, they want to come as close as possible to 0. We're going to focus in on the probability of an option expiring in the money or with intrinsic value. Now, our strike selections, or the moneyness of our strikes, let's fall into three general categories. Now, an in-the-money strike, and we're going to focus on taking a defensive posture for our trade. An in-the-money strike gives you the greatest downside protection because it has an intrinsic value component to it. At-the-money calls and out-of-the-money calls do not have intrinsic value components, only time value components. So therefore, an in-the-money strike or strikes with higher deltas tend to give you more protection. So you're taking a more defensive posture. At-the-money strikes, stock trading at 50, you sell the 50 call, gives you the highest initial time value return, and it's a more bullish position to take. Now, the most bullish position to take with covered call writing is the out-of-the-money strike. So you're agreeing to sell your shares at a higher price than they're currently trading for, because that gives us the opportunity for two income streams per trade, one from the premium of the option and the other from share appreciation from current market value up to that out of the money strike price. And that's the most aggressive. Now, we also have to decide on what expiration dates to use. I favor monthly options, but I do have in some of my portfolios where I trade weekly options as well. I try to stay away from longer term options so I could constantly reevaluate my bullish assumptions on the underlying securities. Plus, shorter term options give higher annualized returns. So, what is the best delta for a defensive posture? Well, I kind of already hinted that the delta would be for defensive posture higher or closer to 1 or closer to 100 per contract. So between zero point 0.5 and 1.0. So that would be a more defensive posture to take. So let's go into the real life example now with AMD, and let's evaluate option returns and protection as they relate to delta. Now, this was created as of June 29th, 2020, and that's where I got these statistics on that date. So on June 29th, AMD was trading at $50.10. Now, if we're going to take a defensive posture, we're going to look for in-the-money strikes with higher deltas. So that means strikes lower than 50.10. Now, there are only 19 calendar days remaining until expiration of the July contracts. So if you're looking to annualize these returns, you could see that you would have to multiply by a factor incorporating the fact that this is only a 19-day trade. What is our goal? Well, I'm going to set a goal at 2 to 3% for the 19 days. And we're going to look to get significant downside protection. So there's two components to the option. One is the time value return, and the BCI calculators will give us that. I'll speak about that in a second. And then how much protection of that time value return are we getting? I'm not talking about the percentage to break even. I'm talking about how much can that stock decline and still generate the initial time value return that we're seeking. We're going to look specifically now at the 46 call. So again, the stock is trading at 50.10. So that's in the money by $4.10. And the 47 call, which is also in the money. Now, the 46 call had a bid price of 510 and a delta of 75. The 47 call had a bid price of 440, lower, with a delta of 70. So more protection for the 46 call than for the 47 call, but the deltas are pretty close, 75 and 70. Now, if we took this information and we put it into the multiple tab of one of our BCI calculators, into the blue cells on the left, for those of you watching this podcast, you could see a screenshot of that. For those of you just listening, on the left side of the spreadsheet, the cells are blue. That's where we fill in the information we glean from the option chains. Price of AMD, 50.10. Option premiums, 510 for the 46 call, 440 for the 47 call. They both expired 19 days later on July 17th. And here's what the calculator tells us. After deducting the intrinsic value component of these options, the remaining time value initial return is 2.2% for the 46 call and 2.8% for the 47 call. So the 47 call gives a slightly higher return. However, if you take a look at the downside protection of those two premiums, you will see that the 2.2% 46 call had greater downside protection, 8.2%, whereas the 47 call still had a significant but lower downside protection of 6.2%. So one strike offered a slightly lower but still significant return of 2.2% with greater downside protection of 8.2%. And the other gave a higher initial return of 2.8 with a slightly lower downside of 6.2. Which is better? It depends on your strategy goals. So we can't say the 70 delta was better or the 75 delta was better. We say based on what our returns that we're seeking or the downside protection that we're seeking, that particular delta will then be the appropriate one for us. Now, frequently, covered call writers will write out of the money strikes. So the deltas will be usually lower than zero point 0.5. It could be it could be 40, it could be 30, it could be 20. But if you're looking for a defensive posture, all of those are not appropriate, right? So it depends on the moneyness of the strike and the initial time value return goals and how much downside protection you're looking for. That will lead us to a strike that does have a specific delta, but our decision is not made based solely on delta. So really, just to summarize things, folks, strike selection should be based on our strategy goals and our personal risk tolerance, period. Understanding delta and its impact on our trade is important. I'm not minimizing that. But using delta figures as a sole determining factor for our trades is a mistake. We may want to be more bullish and go out of the money and use lower delta strikes. We may want to go deeper in the money and use very high delta strikes. So it's not like one size fits all. Okay, so that's the main point of this particular podcast. I hope that it rings true with everybody viewing this podcast today. Now, I always leave you with pride and joy, our BCI package. I brag about this all the time, so afford me a minute to do that. This is our heavily discounted package, 25% discount off of ordering everything separately on our website. Consists of 6 online video courses, all with downloadable workbooks, 6 calculators created by the blue collar investor, so you'll find them nowhere else, geared to all these option selling strategies that we talk about, 5 of our best-selling books in ebook format, and our annual premium subscription, which consists of watch lists based on stocks, ETFs, and Dow 30 stocks, along with over 200 training videos. We add a new one every month. So there's a huge educational component to the package. And we offer that package again at a 25% discount off the online price and the total price discounted is $9.97. We have our ongoing and never-ending video training, which includes our Ask Alan video library, our Blue Hour in-depth webinar series. We add a few of those every year as well. And every month, you can anticipate at least one new training video. That's our promise to you. Way to get more information on the BCI package, go to our website, www.thebluecollarinvestor.com. And on the top, just click on the link that says BCI package. Ladies and gentlemen, thank you very much for taking the time to listen to this BCI podcast, number 109, Delta and Strike Price Selection. I hope you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.